What's up, everyone, and welcome to The Explainer. Today, we're diving straight into a viral and honestly pretty intense financial breakdown from creator Mirchi98. He's detailing a massive, seemingly imminent shift in how our money is stored, tracked, and invested. Because while everyone's distracted by the stock market hitting all-time highs, a deep dive into recent Treasury data and executive orders points to a completely new landscape for your 401k. It's being called the digital dollar war, and today, we're going to break down exactly what this means for your retirement. To get through all this, here's our quick roadmap. We're going to cover the digital dollar warning, peek inside this new Trump IRA, explain what financial repression actually is, weigh democratization against becoming exit liquidity, and finally, outline a rational investor strategy.
All right, kicking things off with part one, the digital dollar warning.
The source material starts with a really heavy claim. Mirchi98 says, "We are looking at a fundamental shift in how your money is stored, tracked, and invested." The analysis argues that a quiet wealth transfer is being set up entirely behind the scenes, and digital frameworks are about to drastically alter traditional retirement accounts faster than anyone expects. Now, what's kind of funny is how the creator balances this literal doomsday financial warning with, well, a picture of a snail. It's his quirky engagement tax, basically saying, hey, drop a like and subscribe for me staying up all night compiling this data, and here's a random snail as a thank you. But jokes aside, the economic policy he's pulling from demands some serious attention. Moving right along to part two, inside the Trump IRA.
So what's actually going on here? According to the analysis, the big catalyst is an April 30th directive setting up what's being called the Trump IRA. The surface-level goal is pretty straightforward. It's meant to act as a 401k alternative for the roughly 56 million Americans, like gig workers, who currently just don't have access to traditional employer-sponsored plans. But Mirchi98 points out there's a massive secret layer to this directive.
That secret layer? It's a provision that allows alternative investments to be held directly within these brand new retirement accounts. We aren't just talking about your standard, boring index funds or bonds anymore. This opens up the gates of the legacy banking system to things like private equity, real estate, and most notably, digital assets like cryptocurrency. Which really begs the question, why on earth would the government want highly volatile digital assets integrated into everyday retirement accounts?
Well, that brings us to part three, explaining financial repression.
The creator drops this incredibly intense line: the government is essentially setting the stage for what economists call financial repression. And that completely shifts this whole conversation away from just your personal retirement account to the massive scale of United States monetary policy. If you're not familiar, financial repression is basically a strategy where a government intentionally keeps interest rates artificially low while letting inflation run a bit hotter than usual. What this does is effectively devalue their own debt over time. Think about it. If inflation is growing faster than the interest the government pays, the real value of their debt shrinks, making it so much easier for them to pay back. And to understand why they might utilize this strategy right now, you just have to look at the numbers, specifically $40 trillion. That is the jaw-dropping amount of current U.S. national debt that the government somehow has to manage. Add to that a $2 trillion annual deficit, and you've got a serious problem. Historically speaking, as the source points out, the absolute easiest way to get out from under that kind of crushing debt without triggering a total economic collapse is to literally just inflate your way out of it. But here's the catch, and it's a big one for you and me. Under this digital dollar framework and financial repression, we get this crazy, dangerous paradox. Your asset prices, your stocks, your house, maybe your crypto in your new IRA might look like they are melting up in dollar terms. You look at your account and think you're getting rich. But in reality, your actual purchasing power, what those dollars can actually buy at the grocery store, is flatlining or even falling. It is the ultimate invisible squeeze on the everyday saver. So is this a good thing or a bad thing? Let's dive into part four, democratization or exit liquidity. We really have to look at both sides impartially here. On one hand, you have the big institutional view from giants like BlackRock and Goldman Sachs. They are rushing into this digital transition because they argue it creates massive market efficiency, attracts necessary capital, and democratizes the upside. Their point is, hey, why shouldn't regular workers have the exact same access to high-growth crypto or private equity deals that pension funds and billionaires do? But on the flip side, critics are sounding the alarm. They argue this whole thing is nothing but a massive payday for Wall Street, where everyday workers are inevitably going to get stuck with super expensive, complicated products that benefit the fund managers way more than the actual retirees.
And that critical view introduces a frankly terrifying concept in finance: exit liquidity. The warning from the source is stark. If complex, hard-to-value assets are suddenly shoved into 56 million new retirement accounts, everyday investors might end up buying into the hype right at the absolute peak of a bubble. And by buying in, retail investors provide the cash, the liquidity that large institutional players need to sell out, take their massive profits, and leave everyone else holding the bag. Now, right in the middle of all this macro uncertainty, the creator does a pretty brilliant pivot to practical protection, highlighting that your digital safety is just as crucial as your financial safety. Simple things like using a VPN to encrypt your data matter. Plus, optimizing your cash flow is huge. The creator mentions using a sponsor, Rocket Money, to audit subscriptions and saving $100 a month in just 10 minutes. That's $1,200 a year of found money that can be immediately reinvested back into the market. Which leads us perfectly into Part 5, the rational investor strategy. So what's the actual game plan here? First off, let's look at the math on this upcoming Trump IRA match because it's pretty wild. If you're a single filer making under $35,500, starting in 2027, the government will actually give you a dollar-for-dollar match on your first $2,000 contributed, up to $1,000. That is literally a guaranteed 50% return before your money even hits the market. It's free money, and you absolutely shouldn't ignore it. Second, the overarching message is you have to take personal responsibility. You have to be your own fiduciary. Listen, just because the government now says you can buy private equity or crypto in your retirement account, absolutely does not mean you should go all in. These alternative assets are notoriously hard to value, and more importantly, they come with insanely high fees. We're talking 2 to 5% a year in management fees. Over a 30-year investing timeline, a 5% annual fee will absolutely decimate your compound interest compared to a simple, low-cost fund. Ultimately, despite all the alarm bells about digital dollar wars, the source's personal strategy is surprisingly traditional. It boils down to consistent dollar cost averaging into a massive slice of broad, low-cost index funds, while keeping just a tiny diversified slice for those digital assets. It turns out the best approach to navigating this whole transition is the most time-tested, conservative investment strategy there is, choosing consistency over hype. Because let's face it, the market and these shifting macro policies will always churn out headlines designed to make you feel like you're missing out. But when the dust settles and the media noise tries to panic you into selling at the bottom or FOMO buying at the top, will you have the discipline to just stay consistent? Thanks for hanging out with me for this explainer, and keep learning.